charts. As supply and demand traders, the way that we're going to determine when and where we would like to buy and sell in the financial markets by analyzing the charts. The question that we're going to seek to answer is, where are the unfilled orders sitting on a price chart? Now, charts represent filled orders in a market through time. So the classic definition of chart is simply a representation of price as it moves through time. The vertical axis on a chart measures price, and the horizontal axis corresponds to time. Now we're going to look at the charts as filled orders through time. Now, filled orders, it's what's already happened, the transactions that have already happened. So we're going to use those to find the unfilled orders. That's going to tell us something about what will happen. That will help us time the markets. So essentially, a chart of filled orders is the opposite of what we need. We need to look for those unfilled orders. If you think about a negative from the chemical photography era, this represents the inverse picture or the opposite picture of the photo that was actually taken. And that's really what we're looking at here. The chart represents what has already happened, the orders that have already been filled, and we're going to use that to identify with a high degree of probability where the unfilled orders are sitting or lurking in the background. Some basics of a chart. At the top here, we have information about a given stock. Here is the ticker symbol for the stock as well as the time frame. Now the time frame here, 2 minutes, simply means that each one of these bars that we refer to as a candle represents where price moved during 2 minutes of time. Once that 2 minutes ends, that candle becomes concrete with all the transactions that have happened during those 2 minutes of time, and a new candle begins to form. And as transactions are taken, that candle will move up and down as price fluctuates. And that is the time frame. The 2 minutes there is the time frame. Also at the top you have the opening price, the high price of the day, the low price of the day. At the bottom you have the date and time, as the horizontal axis represents time or corresponds with time. And the vertical axis corresponds with price, current price being highlighted there over on the right hand side. Also at the top you have the day's volume. Volume just being the number of shares that have exchanged hands. Now, different trading purposes are going to use different time frames, and really your trading purpose is going to be based on your availability to be in the markets and your goal. You may want to trade actively for just a couple of hours and be in and out and call it a day after that. Or you might want to be a little more passive and put on trades that last a longer period of time, and you're not as active on a daily basis. So your trading purpose is really going to determine how long these trades are held and the time frames that you're going to be looking at. As an hourly income trader, the time frames that you're going to be using are much smaller than if you're a monthly income trader. The time frames will be much larger. Here we have 4 charts that represent the same product or the same financial market. And what you can see here is that on each chart we have a different picture even though they represent the same product. So on a weekly chart, each candle represents price movement over a week's span. If you think about it, one candle on a weekly chart becomes 5 candles on a daily chart, as there are 5 trading days during a week. So The daily chart's going to give us a slightly different picture, as in the same span of time, you're going to have 5 times the number of candles on a daily chart. And this goes on as the time frames get smaller. On a 15-minute chart, these candles are broken down further, and on a 2-minute chart, even more so. For this reason, it's important to look at a few different time frames for each market that we trade. You'll notice that each trading purpose has 3 time frames sitting next to it. That's because, like we said, you're always going to be looking at multiple time frames to get a full picture of what's going on in the product or with the product that you're trading.